entry on 2 trades that I've taken and one that I have not taken but predicted on the Discord. So this is the first trade, which was a retracement down and a break of structure and a retracement up to the fair value gap, and then we were looking for price to go to the fair value gap, and it done that. And this is the second trade that I've outlined, but I did not get the opportunity to sell it down. So we're expecting a break of structure, a retracement up, and then trade down to this fair value gap. So as you can see, it's retraced in the morning, and I wasn't in the chart at this time to be able to take this trade down. We start our analysis with the daily chart, and as you can see, during that day we've taken out this major point of liquidity that had market consolidating in the range of it for 2 weeks. We've taken that on Friday, and towards the end of Friday we were expecting a Judas swing to occur, and then for market to trade down inside this consolidation range on the daily time frame. On the left hand side, you can see we have a bullish order block on the daily time frame, and on top of it we have buy side liquidity. So this is a liquidity that was created almost a year ago, and market has traded down ever since from that level and now has traded back up to it. In my opinion, we already traded down from that level. I don't think this trading down is going to break any structures in the future. I think the market will most likely continue higher, unless say we can't trade down to these levels and we break structure, then our bias changes to bearishness, or we will start selling it from the daily time frame. But as of now, we've traded once. We're really not guaranteed to trade it twice and go even lower. We're not really guaranteed to do that now. 4-hour time frame, as you can see, this is the buy side liquidity that we outlined on the daily time frame. The market has traded past it during the Friday trading hours. We're expecting Judas swing to occur along the top here, and then market to come back and fill this fair value gap that was created. As you can see, a lot of buying happened here, or the algorithm started accepting buying orders at this 4-hour candle, and therefore we left this fair value gap, and market had to trade down to it. As you can see, every fair value gap, market finds time to trade into it and then trade over, and really big ones get traded inside, and market tends to fill them all. This big one over here, market filled the whole of it. This fair value gap here, market filled the whole of it, similar to this one. But this fair value gap was created when this buy side liquidity was taken, so market had to provide some Judas swing on top of it and then trade down, and we traded down to this order block. But obviously when we were trading here and we were taking the trade, we didn't know it would trade down to here. I just had this short-term mindset of market trading down to this fair value gap, or the midpoint of it. But right now it's traded into the order block, and in my time frame, as you can see, we have the buy side liquidity that we outlined on the daily time frame, and market took that out within 4-hour period and the trading period of Friday. And towards the end of Friday, we were expecting this Judas swing to occur because we were above this high. We were expecting the Judas swing. It created a massive 4-hour fair value gap, so the high of it and the low of it had literally around 60 pips in between. So market hadn't provided any retracements on this 4-hour candle, so therefore we had to trade back down to rebalance the whole move, and we came back down into this order block. And in my opinion, this order block is probably going to provide market some movement away into this area or even higher, and that will be seen as retracement because of this impulsive move. that filled the whole gap. 15-minute time frame, and as you can see, we've been trading up and up, and all these bullish candles wouldn't indicate to you any breaks of structures to the left hand side. So without knowing this high that was formed on Thursday, 13 April 2023, you wouldn't have known a Judas swing was going to occur, because you just saw these bullish candles. You expect market to keep going up, the trades probably go up, but obviously we have the 4 hours that told us, you know, we were above an area of old high, and market will likely retrace it down to the consolidation that we outlined. So you would have known, like, to be selling whenever you see these breaks or structures. However, on the 15-minute, it's not really clear like where the break of structure is, because our next high and low is literally like all the way down here, and you're not going to be waiting until it gets down here to be taking trades from up here, because that's almost around 70 pips. So you will not be waiting 70 pips to see a break of structure. So now we drop into the 3-minute to see a more up-to-date execution of that trade. As you can see, we saw market create relative equal highs, we break above it, we break down, we retrace up, and then we close below this wick. This is very important. I only use breaks of structures when, or I only see breaks of structures when market closes beneath my wick. So if this wick was there and the market just wicked it like this and went above, I'm not going to consider this as a break of structure, because market hasn't provided me any closures below that low that was formed here. Therefore, I saw this retracement and I took the trade, and as you can see, there's a little fair value gap that's formed over here. So we trusted that and we put the stop loss above the high, and we took the trade down to the fair value gap that was outlined in the previous, towards the start of the video. And ultimately we were targeting this sell side liquidity that was formed here, this low that created this low, and market traded down to it. A trade because I did not execute on my trading account, but I outlined the screenshots on the Discord. So we saw further decline of price. So we saw further decline of price, and we broke below this low, and we were expecting price to trade up into this order block on the 5-minute. You will see it better. The 5-minute, you see this bullish candle prior to us going down, and this fair value gap that was formed. So the market created relative equal highs, went above, and tapped into the wick of that order block, and then started heading down. As we break more structural points, so this low, see, we break beneath it, we stop beneath it right there. We trade up into these 3 consecutive candles. That form our order block, and then we just traded all the way down until we found support around this level that we're trading at right now. So if we hypothetically held this trade from up here, expecting market to come all the way down to these levels, at least this level, we'll be expecting a trade that is around 01 to 19, which is crazy. But obviously we're using the lower time frames, therefore our stop losses was quite small, only risking 5 pips to gain around 102 pips. But obviously that's in hindsight right now, and we'll probably have taken partials along the way. Like, we should have taken partials when it came down here, and then when it comes down to here. If it was a normal day, so imagine it was a Monday or Tuesday, and this was the New York trade, I'd have possibly held it all the way to these lows. But it was on a Friday and it was the end of the day. So my expectation of the market was literally this low, and then I wasn't expecting the whole move to happen the next day because it was bank holiday. So it's very important to have certain expectations of the market. If you enter a trade on a Monday, expect that trade to pan out until at least Wednesday. But if you enter a trade on a Friday, don't expect the market to break all the way down in a single day. It will probably come down for that day, but then it will change structure maybe on the next day. So you should never hold a trade too long, expecting, the 200, 100 pip moves with a 6 pip stop loss to just keep going all the way down. I have taken a number of trades and I have outlined around 3 potential trades that you could have taken. As you can see, we have the fair value gap here. Market has traded into it, then broke structure from this point and came back down to this fair value gap. And then you could have taken that trade targeting these relative equal highs. And that's just after London kill zone open, or just after it. So we have the London kill zone open lows, and market traded up during New York kill zone, which is delineated by this green box. So from around 7 to around 12 o'clock is the New York kill zone. We traded up, and then we traded up into this consecutive bullish candles before the down move, and we broke structure right here. Once we closed below that wick, we did a break of structure. We traded up into this fair value gap, and then this bullish order block after taking this liquidity and the relative equal highs out. So you can see this as a Judas swing up, these 3 candles, and then down. Now the real move occurs. So you could have taken the trade from there, from the fair value gap, put the stop loss above the high, and then targeted the London kill zone lows. In my opinion, this is the most probable trade that I would have taken if I was on the chart at that time. But I was not on the chart, and yeah, we missed that trade out. Also, this one is quite an unconventional one. As you can see, we have this area of order block that led the market to create the high highs, but we traded through it. So that will act as a breaker block. You're gonna put your stop loss above the breaker block, which is above these down close candles, and then you could have targeted these lows that are found here. So that trade would have been a bit tricky because you'd have seen the London kill zone lows getting taken, so you might have anticipated, say, a break of structure here, and then probably a move up into these fair value gaps for a better selling opportunity. But once it didn't close above this breaker block, you could have seen this as a short entry down into those lows. This next segment of the video, I'll be discussing my opinion on what could happen in the market in the next few days. As you may be aware of, this is the first week of May, and we often get the most volatile period of the month during the first week of May. And the most important days are Wednesday and Friday. Wednesday, we get the FOMC statement release, so that means the Federal Reserve of the United States that's responsible for maintaining the dollar and its hegemony in the world. The guy comes out and he makes a statement on the interest rate, and if he's gonna increase it or decrease it, or things he's gonna be doing for the dollar and the US economy. Also on Friday we have the non-farm payroll and the unemployment rate. So these suggest to us like the health of how healthy the economy of the United States is, and they also provide certain liquidity. So all of these provide liquidity for the market, as you might know. And during these times is most likely what we're gonna do is we're gonna close the algorithm, and the market will be manually operated by people. So when this news gets released, the algorithm shuts down, and people actually come in and start moving price, because they do that. Like during these times, you should not be trading. Like you must not be placing trades during these times. If you have trades open during this time, is it could go either way. It could go to your profit, which is good for you, or it could come down all the way to your stop loss and even go further. And then you'll be owing your broker money. And the new person to trading, I recommend you to close all your trade 30 minutes before the news gets released, and only trade 30 to 1 hour after the new news gets released. This is because if you are in profit, for example, on a trade, and the news gets released, you don't really know what it is gonna do. It could hit your take profit first and then come down, or it could hit your stop loss then go up. So do not let chances dictate whether your position should be winning or losing. You should close your trade. If it's on a loss, close it. And the is gonna get released 30 minutes, close it. If it's on a profit, close it. So this is a rule of thumb. The first week of trading, my historically my analysis has been quite shambolic. Like I don't really get like the drawn liquidities on the first week of the month because of, say, too many manipulations or things that are just out of my control that start happening during the start of the month. Therefore, please do not take this as financial advice. If I start saying, market's gonna go there, yeah, probably it will go there, but the accuracy is very low during this time of the month. And also it could start giving us opportunities like 10 minutes before the news opens, and then it runs there in 10 minutes. Like it gives you opportunity to enter a high low or order block or a breaker block or anything, and then it just goes higher, 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 and then yeah, you're not able to enter it because the news is getting released. So let's move on now. What I can see on the 4 hours is the fact that we are in this order block, we're trading in there. Therefore, from the get-go, I think the market is going to retrace at least 30 or at least 50% um, of this bullish candle. So we'll get at least like a movement up to here, and then we can start going down from there. And also the fact that we have created this high, went lower, this high went lower. I don't really trust the same thing to be happening. Like I don't think we will go lower as much as we did here. So this will provide us our line of defense. So this candle is going to be the one that propels price to go higher. So tomorrow, for example, if I get an entry around here and the market stays here and doesn't move tonight, all the way up here, and we get the entry in the morning during London session, I will look to enter a trade and then at least go to the 50 of this order block, or this bullish candle in the middle. So we'll call it bearish engulfing this area. It's not really an order block because it hasn't really taken out liquidity. So we'll target there. So that's the 4 hours. And also, I don't like the fact that we are getting this trend line kind of formation. I do not like it because what it does is it entices more like retail traders to start buying. So they bought it here, it worked out. They bought it here, it worked out. Here, it worked out. So we're building up narrative here for retail traders to start buying from here. So I don't really think this buy is going to be sustainable. Even if it happens, I still think market is going to come down from there and probably come lower towards the 50 of this order block, the 50%, like come down lower, and then eventually, if it does that, I will consider this, because the trend line is literally is non-existence. All those guys are trying to buy it now. They're not gonna try and buy it when it comes down here. So yeah, just the dilemma I'm faced with right now. Okay. Also, let's not forget the fact that we are inside this order block. I mean, sorry, uh, the fair value gap right here. So if we trade in, this is what I use sometimes. If we trade in here, close inside, we're mostly going to target or go inside this bearish engulfing, this candle here. Might go in there. If we close like in here, we might just get the momentum to go up there. But if we keep respecting this fair value gap and market keeps wicking that level on the 4-hour time frame, we might just come down to here, the 50, and then that will give us a better entry to go up. Sorry, to go higher. That'll be nice. So best case scenario, I'm waiting for price to go in here, go get us down, and then buy it from there. This is the 15-minute. You can see we have a area of fair value gap, and we've wicked that level right now. And to the downside, we have relative equal lows that are formed. This is very good for our idea that we will come down and then go up. Because remember, the trend line people are coming in and they're saying, oh, this area is probably going to provide that movement away. But I don't really think so. So we've created this order block and we are trading in it right now. We pulled up and then we came back down a little bit. However, we haven't really like closed beneath that level, but we've created these relative equal lows. So what that means is we have the chance to go higher and then come back down. And then go up in the morning, probably. But if that happens, I'll probably miss the trade, because of we have relative equal lows, and market is giving that thing. So I don't think this is going to be long lasting. So I will look to be selling the market when it comes up here. Then if we miss the buy, from here, then I'll look to do that. But if we keep this range, if we keep these lows, however, when London starts opening, we manipulate these lows, go lower, and then start breaking structure up, then I might look to enter a buy from somewhere around here and then target the highs. And start targeting the highs. That's the best case scenario. If these relative equal lows are left in place and we start drawing down, forming that Judas swing, breaking structure, giving that order block or breaker block entry during the London session or the New York session even, and then start trading up into this. You can see our most recent swing highs here. So this is our buy side liquidity. And our most recent low is down here. And that's our sell side liquidity. So whichever market is closer to, which is this one, will most likely be manipulated in the morning, and then that will frame an idea of a trade. And Also, you can see we're not even trading at a premium. Like we're trading at extreme discount. You see below the 50% is all discount. As we come up here, then sells become viable up here. But right now buys are viable because we're below the 50%. And if we come higher, then sells. We go lower, buys. So that's how I avoid like try to sell it here, because what's the chance of the market going even lower? Quite low. It will probably go lower as a manipulation, but it will not go lower as a sustained move to go below these lows. We first need to see manipulations to the upside or fill of these fair value gaps. Like we need to trade into these fair value gaps here and here to give us a momentum down. But we can't just go anywhere from where we are right now because we haven't filled any of these fair value gaps. And also down here, we only have certain wicks. We have wicks and we have these bullish candles that need to be probably filled. So on the lower time frame, this fair value gap, this area of this bullish candle probably has fair value gaps in it. That's why we want to keep market here, then manipulate, fill the fair value gaps, and then go higher to go for these fair value gaps. So I want to see a drop low and then rise. So that will be my trade. Honestly, the buy will be there. And yeah, we'll just wait for the morning and we'll see what market provides us with. Also, this low is the New York low for Friday. This low is the New York low. Right there. And if you look at the range, so from the top to the bottom, anything red is discount. So when it starts going red, like from here, that's discount you should be buying. You see extreme reds, that means we're extreme discount from this leg to this leg. From up here to up here, we're extreme discount. So at least we should be looking for buys around here to here, and then we'll use this leg over here to take the sales down.